Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
We've got some exciting updates from the world of finance and debt markets in India. Then we'll discuss the latest movements in India's bond markets. Falling oil prices have given bonds a boost, but profit booking is capping the upside, creating a dynamic market environment. Lots to unpack, so let's get started.
Absolutely, Vijendra. First up, we're diving into how three major Indian development financiers are eyeing a massive $1.5 billion in loans. This could have big implications for infrastructure and growth. And lastly, we'll cover ESAF Small Finance Bank's recent fundraising success. They've raised 85 crore rupees through Tier 2 non-convertible debentures at an attractive 11.65% coupon rate.
Three Indian development finance institutions, National Bank for Agriculture and Rural Development, Small Industries Development Bank of India, and National Bank for Financing Infrastructure and Development, are targeting a combined minimum of $1.5 billion through foreign currency loans under the Reserve Bank of India's discounted overseas borrowing facility. NABFID is furthest ahead, already in talks with lenders. NABFID aims to raise up to $2 billion via external commercial borrowings this financial year, targeting 6.5 to 7.0% borrowing costs. It has already raised $125 million through a smaller dollar loan tranche earlier this year. Now, let's discuss another important development. Indian government bonds gained modestly as the 6.94% 2036 bond yield fell by 1.4 basis points to 6.7690%. Lower oil prices, down to $72.24 per barrel, helped ease inflation expectations. Foreign investors boosted purchases by 2.5 billion rupees in June, attracted by RBI incentives and tax cuts. However, El Niño's impact, causing rainfall 40% below average, threatens inflation and agricultural output, influencing upcoming interest rate decisions.
This loan approach avoids debut dollar bond complexities, which are lengthy and cumbersome. With the Reserve Bank of India's subsidized hedging facility reducing currency risk costs, borrowing through loans becomes more practical and cost-effective for these institutions compared to bonds. Meanwhile, NABARD and SIDBI are in preliminary discussions and may enter the market within 30 to 40 days. Given their likely infrequent foreign currency funding needs, loans are more suitable than bonds, with credit costs only marginally higher for loans at present. The drop in oil prices followed shipping resumption through the Strait of Hormuz, reducing fears of sustained high prices. This eased pressure on subsidies and tempered expectations for Reserve Bank of India rate hikes, which the governor called premature. Interest rate derivatives reflect mixed sentiment. The one-year overnight index swap rate fell slightly to 5.76%, while the 5-year edged up to 6.18%, showing cautious optimism amid inflation concerns.
ESAF Small Finance Bank raised rupees 85 crores through 8,500 Basel II compliant lower Tier 2 non-convertible debentures at a fixed coupon rate of 11.65% per annum, maturing in 6 years and 1 month, on July 25, 2032. These bonds are unsecured and subordinated, meaning higher risk compared to secured debt, but they help absorb losses and improve capital adequacy without diluting equity. Moving to our next story, Fincare Financial Services is raising rupees 50 crores through 5,000 secured non-convertible debentures, each worth rupees 1 lakh. The coupon rate is 11.55% per annum, payable quarterly, with a tenure of 2 years, 9 months and 19 days, maturing on April 17, 2029. There's also a penalty clause imposing an additional 2% per annum if payments are delayed beyond 3 months. This incentivizes timely interest and principal servicing, protecting investors from default risk.
This strengthens their Tier 2 capital, crucial for regulatory compliance and financial stability. The fixed coupon at 11.65% reflects their cost of capital, aligning with market rates for similar instruments among small finance banks. Investors should watch quarterly results for interest expense impact and capital ratio improvements, while noting risks of subordinated unsecured debt in stress scenarios. That coupon rate is attractive in today's non-banking financial company debt market. The secured nature with a first-ranking charge on receivables adds safety, which should appeal to institutional investors in this private placement. Plus, new appointments of a chief risk officer and compliance head suggest stronger governance and risk management. This should improve operational resilience and bolster investor confidence amid competitive sector dynamics.
India's micro, small and medium enterprises are central to reaching a $32 trillion economy by 2047. The shift from low-cost manufacturing to innovation, design and technology adoption is critical for this transformation. Right, and the focus is on moving beyond Make in India to design, build and secure in India, especially in electronics and telecom sectors. Talent development and AI adoption are key to this shift.
That aligns with market trends. Karnataka's digital sector alone contributes 35 to 40% of its economy, showing how digital adoption boosts MSME agility and growth potential. Government support in infrastructure, financing, and skill development will be decisive. MSMEs embracing AI can improve productivity without major cost increases, positioning India as a global innovation hub.
Let's look at another key development. Aryan Group has launched a $60 million Category 3 alternative investment fund in Gift City, targeting sophisticated investors interested in India's distressed assets and structured credit market. The strategy focuses on negotiated settlements and strategic monetization, aiming for recovery-driven value creation in special situations. Moving to our next story. Suryodaya Small Finance Bank plans to raise up to Rs 300 crores through Tier 1 instruments and an additional Rs 200 crores via Tier 2 instruments within 12 months, boosting its capital base to support growth and regulatory requirements. The Tier 1 raise could use qualified institutional placements, preferential allotments, or rights issues, while Tier 2 will likely come from bonds or non-convertible debentures, balancing equity and debt funding.
This fund leverages India's growing asset recovery sector through active resolution and operational turnarounds, using a tax-efficient, internationally recognized platform to enhance value in complex investments. This positions the fund well to benefit from India's evolving distressed asset landscape, offering investors exposure to high-potential hands-on asset management opportunities. That capital raise aligns with sector norms where small finance banks maintain strong capital adequacy. It gives Suryodaya flexibility to fund expansion or strengthen its balance sheet as market conditions evolve. Investors should watch for details on pricing and timing since capital issuance may dilute existing shareholders, but it matches moves by peers like AU Small Finance Bank and Equitas Small Finance Bank supporting similar growth strategies.
Let's move on to our next article. The Reserve Bank of India now allows all India financial institutions and housing finance companies to borrow in the term money market. Housing finance firms can borrow up to 200% of their net owned funds as of the previous financial year. Also, standalone primary dealers can now borrow up to 400% of their net owned funds for short-term money, up from 225%. This should boost short-term funding availability significantly.
This move broadens market access, improving liquidity. It's significant for housing finance companies, excluding base-level non-banking financial companies, as they gain new funding sources in a regulated environment. Increasing these limits after the April monetary policy review signals RBI's push to deepen market participation and liquidity. Stakeholders can still provide feedback on these draft rules by July 17th.
Moving to our next story, the Aditya Birla Group has arranged term loans totaling Rs 15,000 crores, led by State Bank of India and Axis Bank, to pursue the acquisition of Spring Energy from Shell plc. Loan tenures are expected between 5 and 10 years, with possible shorter terms under negotiation. Spring Energy's 5 gigawatt portfolio is contracted with reliable Indian state entities. Shell's sale aligns with its strategic focus on core exploration, narrowing bidders to Aditya Birla Group and KKR, with ABG now the sole negotiator.
This syndicate, including Japan's MUFG, highlights strong Indian banking dominance in renewable energy financing. The deal could surpass Adani Green's record acquisition, signaling growing investor confidence in India's renewables market. If completed, this acquisition marks a major consolidation in India's renewable energy sector, potentially reshaping market dynamics and financing patterns amid strategic shifts by global energy players.
Moving to our next story, overseas investors purchased a record Rs 39,640 crores of Indian government bonds in June 2025, surpassing the previous high of Rs 22,005 crores from August 2024. The rupee strengthened from 96.96 to 94.4 against the US dollar, and the 10-year government bond yield fell by 20 basis points to 6.76%, enhancing bond appeal.
This surge follows RBI and government steps like capital gains tax exemptions and expanding the fully accessible route, which boosted foreign interest in Indian sovereign debt markets. Despite optimism, experts caution that US Treasury yields and geopolitical risks could impact sustained foreign portfolio inflows, even as India aims for inclusion in Bloomberg's Global Aggregate Bond Index.
The Reserve Bank of India now mandates a kill switch for all AI models in banks. This lets institutions instantly deactivate AI if it produces harmful outputs, reducing risks in financial operations. Also, AI decision-making must have constant human oversight. High-risk models require approval from the board's risk management committee, not just tech teams, ensuring stricter governance. Let's move on to our next article. The Reserve Bank of India now classifies any non-banking financial company with assets of at least 1 trillion rupees as an upper layer NBFC, replacing the old score-based system with a clear asset size threshold. Government-owned NBFCs are now included in the upper layer with stricter exposure limits and some exemptions, aligning regulations across ownership types.
That's crucial for market stability. Immediate AI shutdowns prevent errors from escalating, protecting both banks and customers from operational losses. Board-level responsibility raises accountability. It addresses risks like automation bias and cybersecurity, promoting safer AI use and transparency for customer-facing systems. This shift brings transparency and forces larger NBFCs to enhance risk management, reflecting the sector's growth and increasing regulatory scrutiny. This means government NBFCs face tougher oversight, but can still exceed limits if they use credit risk transfer instruments, supporting financial stability without stifling growth.
Let's look at another key development. CARE Ratings has reaffirmed Ultratech Cement's AAA rating for long-term facilities and A1 Plus for short-term, with a stable outlook. Their profit after tax rose 35% to Rs 8,188 crores in fiscal year 26. Also, gearing improved to 0.45 times from 0.50, and interest coverage is up to 9.09 times. Their grey cement capacity is over 205 million tons per annum, with 43% energy from green power.
That profit jump signals strong operational efficiency and market demand. With a 16.5% rise in operating income to 88,511 crores, the company's financial health is solid, supporting steady credit ratings. This positions Ultratech well against competitors like Ambuja and Shree Cement. Their target of over 242 million tons by fiscal year 28 and focus on sustainable energy are key to maintaining credit strength amid input cost risks.
Moving to our next story, Vedanta Resources received tenders worth approximately $943 million for its outstanding bonds in an early buyback window, covering about 45% of its total $2.1 billion bonds. Exactly. This early participation signals market approval of Vedanta's strategy to reduce refinancing risks and optimize its capital structure through this buyback initiative. Let's look at another key development. Cholamandalam Investment accepted bids totaling Rs 20 billion through 7-year subordinated bonds at an 8.88% coupon rate, showing strong investor confidence. This bond issue, including a green shoe option, will strengthen their capital structure significantly over the next 7 years.
That shows strong investor confidence, especially since these bonds matured between the years 2030 and 2033, reflecting trust in Vedanta's medium to long-term debt management. It also suggests investors value the company's improving credit profile and the attractive yields, making this a positive step in Vedanta's broader debt management approach. The AA+ rating from ICRA and India Ratings highlights solid credit quality, supporting demand despite the long tenure of 7 years. Such robust subscription reflects positive market sentiment towards Cholafin's financial stability and growth prospects.
Let's look at another key development. Cube Highways Trust raised Rs 6.37 billion through bonds maturing in 11 years and 9 months, with a coupon rate of 7.3925% per annum, rated AAA by CRISIL. Compared to Cholamandalam's recent 7-year bonds at 8.88% per annum, Cube's longer tenure and lower coupon reflect confidence in their credit profile. Now let's discuss another important development. The Reserve Bank of India is proposing draft guidelines to allow short positions in government securities. For liquid securities, short positions can be up to 2% of outstanding stock or Rs 500 crores, whichever is higher. The draft also introduces trading of when-issued securities to set market clearing prices before bonds are issued. Short positions must be covered within 3 months to avoid indefinite exposure.
That AAA rating shows strong credit quality, attracting solid investor interest, especially in infrastructure, where long-term borrowing at competitive rates is crucial. This trend signals robust demand for high-rated infrastructure debt, supporting India's growing long-term financing needs in this sector. This should improve market liquidity and price discovery, especially as foreign portfolio investors have shown strong interest with record inflows of 3,960 crores in June alone. Clear limits and operational rules encourage efficient interest rate views and more dynamic trading, which enhances transparency and confidence in the debt market.
Moving to our next story, Like Housing Finance is reissuing bonds maturing in June 2031 with a 7.59% coupon. They plan to raise up to Rs 30 crores, including a base of Rs 5 crores and a greenshoe option of Rs 25 crores. Bidding is set for June 29th. Let's look at another key development. Sundaram Finance plans to raise Rs 7.5 billion through bonds maturing in August 2028. The coupon rate is 7.75% with a yield of 7.74%, and these bonds carry a AAA rating from CRISIL. Alongside Sundaram, like Housing and REC are launching sizable AAA rated bonds with tenures ranging from 2 to 5 years, and Cube Highways is issuing longer 11 years and 9 months bonds, all indicating robust activity in the AAA corporate bond segment.
The bonds carry a AAA rating from CARE and CRISIL, indicating strong credit quality. This reissue fits a trend of high-quality issuers tapping the bond market recently, signaling investor confidence in long-term paper despite current rate volatility. Given the AAA rating and competitive yield, this issue should attract strong investor interest, especially since the tenure is just 2 years and 1 month, offering relatively short-term exposure for high-quality debt investors. This cluster of high-grade bond issuances suggests steady demand for secure fixed income, with issuers offering various maturities to cater to diverse investor preferences, maintaining confidence in the Indian rupee debt market.